A recession that feels like a minor recession actually could become a relatively severe recession very quickly. It's when you go to sell under those conditions, you've actually destroyed the universe of potential investors who would have any interest in buying it anywhere close to that. And so what you actually experience then is a crash that takes you below fair values, and you really never recover from it.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, the election's over and we've got a clear victor. What kind of economy is President-elect Trump inheriting? And what impact on it are his policies likely to have? And what will that mean for investors? Where do the opportunities as well as the risks lie? To discuss, we're fortunate to be joined again by Michael Green, Portfolio Manager and Chief Strategist at Simplify Asset Management. Mike, thanks so much for joining us today.
It's a pleasure to be here again, Adam. Thank you for having me.
Hey, thanks for coming on. This is like twice in a week I get to see you. We did a debate a little while ago for Zero Hedge. So it's like Christmas coming twice. Look, I got a lot of questions for you. And like I said in the intro, it's kind of a brand new ball game. We got a new administration coming into town. Before we get there, let me just kick this off with the general question I like to ask you at the start of these, Mike. What's your current assessment of the global economy and financial markets?
I think that the two are increasingly separated, right? So if I look around the world at global equity markets in particular, I think that they largely reflect the impact of something you've heard me talk about over and over again, which is passive investing, which raises valuations. And unfortunately, that's treated as a sentiment component for the economy. So we tend to try to interpret what's going on in the economy in the lens of, is the S&P making new all-time highs? What does the valuation look like on the S&P? And for most of your listeners, there's certainly a component of, what does my portfolio look like, right? So when we think about what we're actually trying to do, I think it's important to separate kind of the underlying data that we're seeing from what we're seeing in terms of, the economic indicators, things like the S&P 500 or other components. If I look around the global economy, as paradoxical as it feels, I would argue that everything we're seeing is consistent with an economy that is suffering from a lack of aggregate demand. The most notable component of this would be things like oil prices being quite weak versus expectations that they would be very strong. That in turn suggests that China is far weaker than people expect, despite the fact that it has, managed to push its trade surplus to about $1 trillion, which appears to be an incredible amount of strength. The flip side of that is just remembering that that's really telling you that their internal demand is actually not capable of rising to meet the productive capability that they have. They are now somewhat trapped in the position of producer to the world, right? Now that sounds awesome. You want to be producer to the world, right? We're supposed to make things, not consume things. But the simple reality is that puts you into a very tenuous place where the rest of the world can begin to charge you for access to their customers.
Mm-hmm.
That's really kind of the right way to think about a US citizen, somebody inhabiting US soil. It's one of the reasons why things like strong borders are so important, is because they ultimately represent the physical barrier around access to those customers, to those clients that you are supposed to represent through a Republican system, right? A representative democracy. And I think that's kind of going to be the most interesting question about the economy. If you talk to people in the economy, this wasn't so much a vote for Trump as much as it was a vote for reprioritization. The quantity of negative voting, I think, was extraordinary. But there was much more negative voting against Kamala Harris, not because of her skin color or because of her sex, but because simply people felt that the Democratic Party had lost focus in terms of what was actually important to the average American household. And they were voting with their wallets and their checkbooks, right, which are worth less relative to what they need to buy every single day. The economy under the Biden administration, and this has been something that's been going on for a long time, has very deeply bifurcated into those that are needing to sell their labor and produce on a daily basis in order to meet their financial objectives, and those who effectively are able to capitalize, right, the traditional capitalist, on the ability to outsource that labor all over the globe, right? So when we think about tariffs and we think about trade changes under Trump, the primary point I would make is one very similar to what Michael Pettis in China made earlier today, which is what we're really actually talking about is taxing corporations that choose to source from China or other countries abroad as compared to sourcing in the United States. And that's going to be the real question. Does that action actually result in a diminution of aggregate demand because it simply shows up as higher prices, right? Amazon
Right.
decides to source from Malaysia instead of China, and therefore costs are higher, but American workers have no more income. If that's the case, then you'll see a loss of aggregate demand coming from China. You'll see a modest increase in aggregate demand coming from a place like Malaysia or other related countries, and the US consumer is going to be worse off. If on the flip side, the super positive aspect of it is similar to what transpired for Japan in the late 1980s, early 1990s, in which the Japanese acknowledge, okay, we have to actually consume more. We can't continue to run these trade surpluses in this manner. We're going to have to invest in Tennessee. We're going to have to invest in South Carolina and Georgia and various other places, to Indiana, to build cars in the United States to sell to American citizens. Then you could actually see a very positive impulse associated with it. Unfortunately, my hunch is that there's going to be a lot of resistance to that, primarily, again, because China suffers from a shortage of aggregate demand, a population that is now declining, urbanization has slowed to a crawl. Those all create conditions under which the need to consume additional amounts really is not there, right? And
Yep.
so, again, everything I see suggests a world that is somewhat trapped in a loss of aggregate demand, which of course then translates into a surplus to reinvest in financial markets. And that in turn is why I see the two as not necessarily indicating the same outcome.
Okay. And it's interesting because people tend to think the markets are a projection of where the economy is headed, right? If we
Mhm.
think the economy is going to grow, stock prices should, earnings expectations should rise, stocks should get richer. And you're basically saying we're sort of seeing that price dynamic, but for very different reasons than most people would expect.
Correct. And you
Okay.
see this in the earnings in corporations, right? I mean, the traditional earnings valuation, the PE ratios that you see for Schiller PEs, et cetera, those are all calculated off of GAAP earnings, right? Generally accepted accounting practices. Those actually haven't shifted at all. What we've really seen is an increase in an isolated set of companies, the AI affiliated companies and those that are selling the equipment to build this component are seeing an increase in earnings associated with it. But the liberal accounting policies that are being used to accommodate that don't qualify those earnings under a GAAP basis, right? So we're seeing the same sort of bifurcation that you would have seen with a WeWork or a Cisco in 1999, where it appears that a lot of the profits that we're seeing coming out, particularly in the S&P, are somewhat overstated.
Okay. So obviously, I'm going to dig into this in just a little bit. Obviously, big question that this raises is how long can this sustain, right?
Yeah.
Um, but if we can, let's focus on the U.S. for a second. As I mentioned in the intro, just had a new president elected. From your estimation, what kind of an economy is Trump inheriting here?
Well, again, I think he's inheriting a bifurcated economy that can effectively be split between those who are rich in financial assets and therefore don't need to borrow and instead benefit from higher interest rates through increased income, and those that are trying to get their start in life, who need to borrow to effectively obtain capital to use in their productive career, right? You graduate from college, you need a suit, you need a car, you need an apartment, you need, right? And all of those things, renting an apartment is just a form of taking out debt, right? And saying, I will offer you payment to allow you to service the costs that you incurred in terms of building this house for me, right? All of that has to be put in place for those individuals beforehand. And by hiking interest rates, we've actually disadvantaged that segment of the economy. We see this particularly in the unemployment area, where many of the tools that have allowed other Americans to avoid filing for unemployment when they lost their job, things like Uber, et cetera, are less available to the younger generation. Many states actually ban those under the age of 25 for driving for Uber because of insurance purposes. Same reason they can't rent a car at the airport, for
Right.
example. And we actually see this in the data. So there is a very marked deterioration in the unemployment rate for those under the age of 25 relative to all other age groups. When I talk to my daughter, who is in the process of graduating college from a fantastic school and has done very well herself, many of her friends are now really struggling to find employment or internships or the opportunities to get on that ladder. And that's happening at the top end. Everything I'm hearing suggests that in less prestigious institutions, it's even
It's
worse.
been worse. Yeah. My daughter graduated last year from a good college, and I saw the same challenges amongst her peer set.
Yeah, no, it is really remarkable. And when we talk about like what does the economy mean or what does the market mean, part of the reason we do that is because we steal from Adam Smith, right? Price is the mechanism of information exchange in a market economy. We look at prices to divine information, both in terms of their utility and their value to us, right? So we look at the S&P, we're like, oh, that must mean something, right?
Right.
Well, really, it just means where trades cross, right? Um, the same thing has happened in education, as we've talked about over and over again, right? When you introduce student loans that are offered without risk to people
Right.
to pursue any degree, what you end up with is a bunch of degrees that are less valuable than you would get if you had a system that was built around price signals, right? I mean,
Right. And if you have a price insensitive lender, meaning the government coming over and basically taking over the lending part, yeah,
you get exactly what you would expect. You have a massive expansion in costs and services, right? The administrative burden on colleges has exploded. And you get a deep desire to service that customer and never tell them that they're wrong, right?
Mhm.
Because why would you, like, you wouldn't want to run the risk that somebody wouldn't attend your institution because they were offended by a microaggression that was held against them, right? And so you end up basically with a system in which nobody ever says no to a kid, through an extended period of them assuming a tremendous amount of debt, where somebody should have said, no, it's really not a good idea to get a degree in underwater basket weaving, right? It's
Yeah.
really not a good idea to show up and violently protest. No, it's really not a good idea to do these things, right? And they're scared to death to say it.
Okay, so I want to dig into this more because obviously this bifurcation, the wealth divide, the growing wealth divide, huge reason why Trump was
Yeah,
ushered in
I agree.
office. Just want to dig a little more in the initial question though, which is in terms of the state of the U.S. economy, is this an economy that you see, is it the cleanest shirt in the dirty laundry basket? It's not perfect, but it's better than the rest, and it's going to benefit going forward. Or, some say, look, it's an economy that's been sort of stumbling and struggling and kind of been kept alive in a zombified way by massive deficit spending, on the fiscal side. And he's inheriting something that's, kind of sick and is going to need to go through some harsh medicine before it gets back on the right track.
Um,
And that is sort of what Trump's language has been on
yeah.
the Trump speech.
So it's a little hard for me to characterize it that way, right? Because in some ways, the deficits that we're incurring right now are just the natural evolution of something we already knew was going to happen, right? We actually, if you look at the deficits that we currently are experiencing, they're almost exactly in line with 2003 projections, right? And that's after the global financial crisis. It's after, a
COVID.
couple of recessions, et cetera. It's after COVID, right? And we're almost exactly where we were, quote unquote, supposed to be. Right. And the reason why is because we decided to build something called Social Security and Medicare and offer benefits and services to those who hit retirement in the United States. And that makes up the majority of the spending. The one additional component that has meant that our results have been slightly worse than expectations is, of course, the accumulation of debt of those periods and then the rapid increase in interest rates.
Right.
But that can be flipped around, right? That rapid increase in interest rates in an environment in which lots of money has been printed and lots of wealth has been created, quote unquote, wealth in terms of paper terms has been created, actually means that when the US government raises interest rates, right, it actually benefits a sizable fraction of the economy.
Yeah, which is crazy. Just because I remember when the Fed announced it was going to start hiking rates, a lot of people I interviewed in this channel said there's no way they'll be able to get above 3%
Right.
because the economy just can't handle it, right? And it's turned out that it's been able to subsist for a lot longer, and it enriched a lot of the population that already had assets. Lo and behold, the population that seems to always benefit no matter what the policy decision is.
Well, that's one of the things that unfortunately stresses me out the most, right? Is because we have an environment in which those who already have are benefiting. It is very hard to incent them to change in a way that is adverse to their interests. And so when you enter into things like identity politics, and again, I think the Democrats significantly overplayed their hands on this. When you enter into an environment of identity politics, that can go in one of two directions. You can either acknowledge these people are exactly like me. I just happen to be more fortunate or have come from a greater skill base, right, and capital base, which I have talked to you a million times. I fully acknowledge my parents, while not wealthy, made every sacrifice on the planet in order to give me a superlative education and position me to compete in a knowledge economy, right? That was a
Mhm.
great series of choices by them. It worked out phenomenally well. I am eternally grateful for it. But to not acknowledge that and therefore not recognize that somehow or another I have to actually take on responsibility associated with that as well, to say we need better governance, to say we need a more fair tax code, to say we have to actually invest, particularly in that younger generation, to ease the burdens on young families and encourage household formation, et cetera. It's just completely disingenuous, but it's completely in keeping with the times.
Mm. All right. Well, look, Trump has, a bold agenda, that's kind of disruptive, in its general nature. Um, I've got a follow-up question to this, but without asking that one first to color your answer. Uh, if Trump is successful in implementing the policies that he's stated so far, what sort of impact do you expect that to have on the economy?
Well, I think it's really important to actually describe successful, right? Because what Trump has made very clear is that tariffs are a negotiating tool. And I think that's
Hmm.
actually a brilliant articulation.
Yep. He
Uh,
hopes to never use them. Right.
right, exactly. So my old boss, Peter Thiel, had a fantastic expression about Trump, which is people take him literally, but not seriously. And so when he says, we're going to institute 20% tariffs and we're going to put 60% tariffs on China, what he's actually saying is to the American corporations, get your sourcing out of China, right? I'm going to make that one very, very clear by talking about punitive tariffs on goods that are imported from China. And at the same time, if you're in one of those other countries that's going to benefit, let's just say it's Malaysia, right, or Vietnam, which would be a more likely candidate. If you're going to receive the influx from, out of China and into your country, you have to acknowledge that benefit that is received by agreeing to import more from the United States or pay a penalty
Right.
associated with
Make me a good deal. Yeah. If you're going to
make
get
me a
it,
good
make me a
deal,
good deal. Right.
right? And so, like, if Trump's really successful, and I actually wrote specifically about this on my Substack, like, there's a point at which a crazy venal person on the other side of the negotiating table is actually an asset for you, right? Like,
Right.
every once in a while, you want to just release the mad dog, right?
Right. He's a bully, but he's our bully. That whole
He's
thing. Yeah.
very well said. And so like again, it boils down to what others respond, right? So Trump has articulated what he would do if we were to put 20% tariffs on all US imports and 60% tariffs on all imports associated with China, and we were to receive no net benefit in terms of increased exports to those countries in exchange for it, then you have a very bad outcome, right? I mean, the simple math is prices go up in the United States. That means that on things that people need, they would have to spend more money on those. That leaves less money available for discretionary purchases and savings. That in turn trickles through the economy with a dramatic slowdown. There's a second policy that Trump has announced that, again, I think is a literally versus seriously component, which is the deportation of illegal immigrants. That can be conducted in a manner that's actually fantastically valuable, right? Trump could make an announcement. You're an illegal immigrant in the United States. You have 30 days to register with the INS. If you have not committed any crimes, if you have not done XYZ, and you have a job, we're going to expedite you through the process of getting a green card so that at minimum, we know you're actually participating in the system on a legal framework.
Hmm.
You go 30 days past that, then there's going to be penalties associated with that. And if you go 30 days past that, let's call it a credit card delinquency of 90 days, right? There's going to be incentives to deport you and you're not coming back, right? Again, could we have a scenario in which everybody declares we suddenly discover a whole bunch more tax revenue associated with illegal immigrants that are currently being paid under the table? the system becomes more fair and everybody is able to pursue it in a, profitable and legal economic framework going forward. It's a possibility. Is it hard? Yes. There's no question about it, right? And so you have to start thinking about what businesses are going to be adversely affected, either from lack of labor supply or from the lack of demand associated with that. We've all seen the TikTok videos of the billionaires and millionaires that have been created by leasing out facilities to illegal immigrants paid for by various states and cities. I'm going to guess those businesses are going to suffer, right? On the flip side of that, are there lots of businesses that could benefit from the type of policy as I outlined it, which is bringing people into the fold, reducing burdens on emergency room services as compared to traditional healthcare for a variety of reasons. Most notably, people are actually not trying to, hide from the INS. Those types of things could have a very positive impact on the economy. We have a model for that in Reagan, who did a similar amnesty for illegal immigrants in the United States in the early 1980s, right? All of these things can go in either direction. And I think that's part of what's so interesting about where we are at this point is we candidly don't know, right? Trump has asked for interim recess appointments. If he gets those, we could hit the ground running and see change kick in immediately, to the point that many politicians have raised. If we don't see those appointments, if we don't see that capability, then we could very well find ourselves 2 years from now still debating what the impact of Trump getting started on his political agenda is. We just don't know.
Okay. Let me, I've got my follow-up question and actually a follow-up to that. So you may have already answered this in what you intimated, but let's get it on the table. Assuming for a moment that Trump is successful in implementing those, right? Meaning he gets the job done. He's hoping to get done on the timeline. He's hoping to get it done. Can that be done without material short-term pain to the economy, right? Can we take a chainsaw to government agencies? Can we deport some material percentage of illegal immigrants? Can we go through this tariff threat of tariffs, tariff war, whatever? Can you get to the other side without having to make some immediate sacrifices that are somewhat painful to the economy in the short term?
I don't see why not, to be entirely honest with you. I know that's a surprising answer, right? Again, like if you succeed, you get all the things that we described. You actually have a system emerge in which countries have decided to encourage imports from the United States in exchange for increased access relative to China. Well, then there's really only one loser, China. Right now, is that net negative for a lot of commodities? Is that net negative for potential world peace? Because China would be expected to fight back against that outcome in a variety of ways. Yes, those I think become key risks. But when you have China printing a trade surplus of $1 trillion globally every year, that's somewhere in the neighborhood of 2 to 3% of global GDP that is subsidizing China's, lack of internal consumption and allowing them to build up resources that are spent in a variety of ways. If you isolate that pain to China, are there going to be losers, including U.S. corporations that have made those investments? Of course. But how much pain there is, again, I think it really becomes an interesting question that doesn't have obvious answers to it.
Okay. I asked the question because let me put it this way. I can see the long-term benefits of those. I can see potential for a lot of short-term disruption, on the way there. And right now, to your point at the beginning of this conversation, markets are extremely richly priced, right? And my follow-up question to you was going to be, if you thought that it was likely going to require short-term pain, is Wall Street and/or Main Street prepared for that? I don't necessarily think Wall Street is, because I think it's priced kind of for perfection at this point in time. And we'll talk about the passive influence in a second. And Main Street, I think, is, they're still kind of on the high that they've been sold through the campaign of, hey, I get elected and we're going to have a great, beautiful economy, and we may end up with that. But we may have to, sacrifice a bit to be able to get to that promised land.
Yeah, I get, again, I think it really just depends, right? If we all get in the boat and start rowing, I think that we'll experience the pain associated with the exercise, but not necessarily the pain associated with not reaching our destination, right? If we dither about it and we basically show uncertainty and chaos or chaotic behavior, which candidly characterized a lot of the Trump first administration, it's one of the things they're trying to address in the second administration.
Mm-hmm.
Then we could very well experience pain and get no benefit, right?
Oh,
So,
absolutely. That's certainly a potential. Yeah, and where I'm going with this, I'll just say it so you can address it in your final
yep.
answer is, kind of should the Trump administration be delivering a message of like national sacrifice? It's not quite the same, but like World War II, hey, we got a big goal, we're going to do the right thing, but we all got to basically, kind of bear the collective burden of getting from here to there, and kind of preparing people that, yeah, there's going to be some rough sledding before things get better. And if he doesn't do that, is that a strategic mistake, or do you think it's not necessary?
Um, so I will tell you what I have advised the Trump administration, or those who are potentially going into the Trump administration, is that they played the game wrong last time, right? They basically encountered, they juiced the economy at the start of the Trump administration and basically set off what was already a somewhat inflationary resurgence. We
Mm-hmm.
see this in wages, we see this in prices if you actually look at the underlying data pre-COVID. Um, and when COVID hit and derailed that experience, it basically meant that they went into the second half with disaster, right? Reagan reversed that process. You had recession early in as you made some of the structural changes associated with it. And then as you came out, things were clearly getting better and you could see the direction associated with it, right?
Right.
So, I can't know what they're going to do. The temptation is always to pump and stimulate upon arrival so people can basically say, hey, look at the new guy, look what he did, right? But I'm kind of hopeful that some harder choices will be made and some thoughtful behavior will be put towards it. But that's all it is at this point, is hope, right?
Okay.
Like I'm friends with some people who are going into, who look like they are going into the administration, individuals like Scott Bessent, et cetera. Those are just really smart, actually committed individuals who I am very, very hopeful will send us down a different path than we have gone when we've simply followed, the academic prescriptions of somebody like Janet Yellen, right?
Right.
Again, like this is the point of indecision. To your point about Wall Street pricing in perfection, I would suggest that we're beyond perfection, right? On a forward PE basis, we're looking at an S&P that is now actually more richly priced than during the dot-com cycle. The PE ratios in the dot-com cycle were a reflection that you had so many unprofitable companies and you were basically putting multiples on their capital, which then looked like the index as a whole was priced extremely richly. But you actually had a ton of companies that were very, very cheap. As a small cap value investor, 1999, 2000 felt like just the most unbelievable opportunity set in history. A lot of people draw attention to the spread between the most richly valued companies and the less richly valued companies, but they're not actually highlighting the fact that those less richly valued companies are much more richly valued than they were 20 years ago, 25 years ago, right? So, I look around at financial markets and I basically say, I think we're trying to price in something actually very, very different. I actually just had a conversation with an academic earlier this morning, where the point was raised, well, if we're trying to make adjustments to the system, we have to acknowledge that the pricing of a market in terms of market cap weights reflects all the expectations, right? And
Mm-hmm.
I think it's really important to separate, and now we'll kind of get into discussions around passive, but remember what expectations mean. As a active value investor, I form expectations about fair value, right? And so I try to say,
Right.
well, I think Apple is worth X. And then I compare how Apple is trading versus X. If Apple is way above X, then I will try to either short Apple or I will neglect to put it into my portfolio. But my trading behavior reflects my expectations about value. When you introduce passive players, they actually have no expectations about the asset or the concept of fair value, presuming
Right.
somebody else has done that for them. But within the index, once I decide I'm going to buy the S&P 500, I've actually implicitly loaded my decision process in the opposite direction, right? So how does something get heavy weights from an index investor? Well, it goes up a lot in price. What about fair value? It actually doesn't matter.
It doesn't matter.
It
Yeah,
doesn't
because they
matter at
have to
all.
buy it. It's
Correct.
buying every single month, right?
Right. And so the consideration for fair value doesn't exist. And so when we talk about expectations and what's embedded, I would actually just argue that largely what we see are the expectations of passive investors that if I dollar cost average into the stock market, I will get something that looks like historic returns. Ironically, we're now actually seeing evidence that the outperformance that we've seen, that in my analysis is a byproduct of that upward pressure from passive investors, is manifesting itself in higher and higher expectations for US equities. Vanguard does a survey of their investors and asks them what their expectations are for the next decade. And mysteriously, right, quote unquote, mysteriously, those expectations have begun to rise dramatically. They started 2024 at like 6%, which is roughly consistent with history. And by the end of, I think it was September, they were up to almost 8%, right? And these are for long-term returns. So people are basically saying, well, yeah, you told me returns were going to be low before because, PE multiples were high. Clearly, you don't know what the hell you're talking about, right? And by the way, they've been right.
Right. I mean, it has become to a certain extent, maybe a large extent, a self-fulfilling prophecy. And let me just, for folks that haven't listened to your analysis of this before, Mike, um, in large ways, it's more than this. But when we talk about capital passive flows, think about all the money that goes into retirement accounts every year, like 401ks for employers and stuff like that. You tell your employer, okay, I want a certain amount of my paycheck allocated to the company 401k. That 401k is set up to invest that money in a select number of funds. And every month that money gets taken from your paycheck, given to the 401k company, and they've got to invest it, right? So as Mike was saying, they're not conducting any sort of active analysis of, well, the assets that are in the 401k, are they looking a little too expensive this month? Maybe I'll buy something else, or maybe we'll hold off. They're not doing any of that. They're just saying, I've given this money, I've got to buy these things that are allocated in the fund. And that happens month after month after month. It is a price insensitive buyer month after month. And as Mike has said, that capital keeps coming in at whatever the price is, and it gets funneled programmatically to however the stocks are allocated in the portfolio. And a lot of these things tend to be market cap weight based. And so those big companies just continue to get fed, and they get bigger and bigger, and the expectations that they're going to go up gets more and more solidified as the prices keep getting pushed up by this programmatic process. Mike, if I said anything there that was wrong, please correct me, but is that more or less correct?
Yeah, I mean, in its simplest form, there were a couple of key changes, right? So you mentioned the idea of I tell my employer I want to invest in this, right? That actually describes the world pre-2006 and the Pension Protection Act, which changed 401ks from something you had to choose to participate in, right? Those of you who are listening who are, roughly our age, distinctly remember getting your jobs, having to fill out your I-9 application, et cetera, and then having the HR manager saying, do you want to take advantage of the 401k or the company stock purchase, plan, right? And you'd say, well, what does that mean? And they say, well, we'll hold, whatever percent you tell us out of your income, and on a pre-tax basis, that'll go invest into the stock market or into various funds that you have to choose, right? So do you
Right.
want to be in growth funds? Do you want to be in bonds, et cetera? The default for a lot of people is like, wait, you're going to take 5% of my paycheck away? No, I don't want to that's mine. I promise I'll do it afterwards, right? Even though it was a terrible mistake. In 2006, that system changed to become an opt-out framework. So
Yep.
unless you now specify at the vast majority of companies that you don't want to do withholdings for a 401k, then you will be opted in. And instead of you making a selection, you will be opted into what's called the QDIA, the Qualified Default Investment Alternative, which, as Adam was describing, is inevitably a series of passive investments.
Okay. But it ends up in this, again, monthly
Right.
programmatic buying.
Right.
And
It is,
so,
it is as Barry Ritholtz has described, the relentless bid for stocks is sourcing itself from those flows.
right. And you have famously coined this the giant mindless robot, right? Which is just out there in the world buying, buying, buying.
Yeah.
So that has created this price in appreciation, some would say price inflation. Um, I don't think you see this changing anytime soon in terms of the structure of it. I know you've warned that, hey, at some point, if this giant mindless robot actually starts um, shrinking, it's or reducing its purchasing, that could really upend the apple cart in the markets here. But presumably trees don't grow to the sky, right? You can't keep having the stock market continue growing faster than the economy forever. At some point, there need to be some sort of connections there. Um, what's your current assessment of the sustainability of these passive capital flows?
So, I mean, there's a couple of things that I would hit on there. Actually, you don't want to share a picture because I've been playing around with how to illustrate this to people here. So maybe your viewers would enjoy a quick snapshot of what's open on my green screen.
I'm sure they would.
So just very quickly, this is just a very rough model of what happens when passive investors come into the market, as you have highlighted, with that relentless giant robotic bid where they need to buy stuff and they're buying it from people who are trying to estimate it on the basis of fair value, but really don't have the capacity to resist, right? For a variety of reasons. The response function from active managers in general is to become more aggressive, right? This is what's called the strategic response in the academic community. But the empirical data we have shows that strategic response is only able to offset about 2/3 of any one impulse, right? And so if you just mechanically think about what that means, it means each dollar into passive starts pushing harder and harder against the remaining pool of active investors. Here on the x-axis, I'm looking at effectively the passive share. I just started at 0, and you can see the impact, and then the yellow roughly represents where we are today, right? Now, the good news is there's still an ecosystem of active investors and informed investors that are basically looking at valuations and saying, hey, these are kind of crazy. I should try to short this, or I should try to bet against that. Although you're seeing less and less of that over time as people basically give up shorting, right? So short interest as a fraction of shares outstanding has started to fall. The headlines are regularly filled with, shorts have lost X billion shorting Tesla or MicroStrategy or anything else. And so we're actually really starting to damage that community, which is unfortunately very consistent with my findings. The reason why I'm showing this is here's the good news. It can grow to the sky. If we were to go to around 70% passive, we would see valuations climb. From my estimate, we're about 170% of normal valuations right now. If we got to 70%, my models say we'd be at 450%. So good news, your NVIDIA is going to the moon, right? If we stopped...
Sorry to interrupt, but this would be like, I mean, what? We would have average PEs of like 50 or 60?
Yeah, which is, by the way, where the top stocks are right now. And, to take it to its logical extreme, at about 70% passive, I would have the Schiller PE, right, which is currently running about 38, and way out of any historical norm, it would be somewhere around 3 times that level, right? So a Schiller PE of like 150.
Okay, and just for folks, because I actually grabbed this chart, maybe I'll put it up here while we're talking about it. But the Schiller PE is at a level right now that's only been matched twice. One was heading right into 2022, and we saw the big market correction that year. It was slightly exceeded by the dot-com peak, but those are the only other times in history we've been this high. And Mike, you're saying, hey, maybe it could still triple from there.
I mean, yes, that's the positive interpretation, right? Now, the societal fear, right? And this is the point that I actually try to emphasize. This sounds fantastic, and it really does feel good driving uphill with no brakes, right? But the problem is where you decide to reverse actually meaningfully impacts the outcomes. And so what I'm illustrating here is just, and again, this is a very simple model, so let's be very straightforward on it, that this is in no way completely accurately capturing everything we're seeing, but I'll show you a couple of charts. You'll be like, oh, That does look an awful lot like that, right? If we were to stop the growth of passive today, that community of active managers would then be somewhat empowered to actually start betting against overvalued stocks. And you would expect over time, without that positive impulse, for values to settle back lower.
All right. And sorry to interrupt, but as you continue, I just want folks to understand you're not saying stop the passive flows entirely. You're just saying stop the growth of them.
Stop the share gain, correct?
Yeah.
Right. And um, I understand that makes me sound like I'm coming from the perspective of an active manager saying, please give me money, right? Well, there's definitely truth to that, but I actually want to emphasize that's not really why I care about this. What I'm emphasizing when I say that is that we have a market that's actually designed for something. Markets are designed to help price that marginal cost of capital to provide that price information to economic actors, right? And for the allocation of capital. We've corrupted the system by trying to turn it into effectively a high income savings account,
Mm-hmm.
right? We talk about what I need from the market as compared to what am I contributing to the market in terms of its ability to price that next marginal dollar of capital. And so we've separated the utility from the outcome. But here's where the problem comes, right? It's not that you yourself are actually going to do terribly if in 4 or 5 years passive has climbed to about 65 or 70%, and we're looking at valuations at the levels that Adam and I talked about. It's when you go to sell under those conditions, you've actually destroyed the universe of potential investors who would have any interest in buying it anywhere close to that. And so what you actually experience then is a crash that takes you below fair values, and you really never recover from it.
Mm.
Right. And that's the fear, right? That's a 1929. It takes us 30 or 40 years to recover that. That's Japan in 1989 type phenomenon. It's China to a certain extent in 2015. I don't want to see that for the United States. And I think it's really important for people to understand that even as their portfolios are benefiting, even as they themselves are doing well, this is effectively one giant sugar rush that has been created by us telling people, well, the safe way to invest is for you to buy everything.
Let me ask you this, Mike. So we have an aging boomer population that owns the majority of financial assets.
Mm-hmm.
Um, as those people, I mean, they are, right? We're still hitting 10,000 baby boomers retire a day, right? I mean, we're getting near the tail end of that wave of boomers. Um, does that just put us on a crash course for that stopping of growth in passive assets coming in, or even a moderate shrink as those boomers turn into net sellers of the equities they built up over their lives?
Um, so it's been less of an issue with the older boomers simply because they did not invest passively, right? So you've heard me talk about this before
Like they had
that,
pensions or whatever.
right, they had pensions and they selected their own stocks. They built their 401ks prior to the Pension Protection Act of 2006. And relative inattention in many situations meant that they continued to invest in traditional forms, right? Inattention, by the way, is a feature of traditional investing. A lot of times people will just forget money is there. And ironically, I'm sure you've seen the studies that say people that forget their money in the stock market
Do the
tend to
best.
outperform those that actively manage their portfolios.
Yeah. Dead
Um,
clients have the best track records, they say.
Dead
Yeah.
clients have the best track records. And that's actually a really critical point because the inflow and outflow that you make from those accounts actually causes frictional behavior. It forces you to actually make changes that incur transaction costs, that incur tax consequences, all sorts of things that if you just ignore all those components, you actually tend to outperform over time. It's one of the reasons 401ks are a great investment vehicle because people are largely shielded from the tax consequences of rebalancing portfolios, transaction activities as well. Um, but the flip side of that is if everybody did that, if everybody engages in that type of behavior, right? My old pal Chris Cole used to say, you know, repeating the same patterns is oftentimes viewed very positively. If I dogmatically invest in the stock market every 2 weeks, that tends to reward me because I'm dollar cost averaging in. I myself am taking advantage of the volatility in the stock market so that I'm buying more when prices are low. and that same amount of dollars buys less when prices are high. Therefore, I actually am benefiting over time from doing that. But the flip side of that equation is those same rules start to work in reverse once you begin to retire and take distributions,
Hmm.
right? So a strategy that works really, really well in terms of dollar cost averaging in and pursuing volatile assets through dollar cost averaging in needs to migrate to less volatile assets with much more consistent payouts, et cetera, as you begin to take distributions, right? The unfortunate reality is that same thing works in reverse. Prices fall. If I need a set quantity of money to cover my bills, I'm going to be selling more when markets are down and less when markets are richly priced, right? So we really haven't seen those baby boomer exits yet in a way that meaningfully impacts us. We are starting to see deterioration in flows. We are seeing evidence that there is less buying of financial assets in total. The flip side of that is a higher and higher fraction of it is going into passive investments, right? So a great example is now that we've hiked interest rates to 4.5% by way of 5.5% or 5.25%, baby boomers who had saved for their retirement and need to take distributions from their 401ks can increasingly just take it in the form of income distributions without ever having to sell.
Having to sell. Yeah, exactly. Yeah.
Right. And so, that's removed some of the pressure that was on the system. I don't think it was intentional, but it has the perverse impact of actually providing additional fuel for the fire.
Right, right, or at least slows the decline. So let me just ask that question one more time. Are we on almost a mathematical trajectory for destiny for that chart collapse there, if you will, simply because of the aging of the demographic? Or is there a way that you think we, have a decent chance of avoiding it?
Like I said, I think if we were to take action today, I think there's a reasonable chance that we have the equivalent of what Goldman and others have called a no or low return decade, right? Vanguard's own strategists, for example, project that.
Yeah.
The great irony, of course, is Vanguard's investors are raising their expectations at the same time Vanguard strategists are saying you should really expect much less.
Yeah.
But perversely, because Vanguard itself locks in strategies on the basis of expected returns to the asset class over very long periods, so they're not changing their allocation because their strategist is saying equities are unlikely to return a fantastic, level going forward. We've all been robbed of that by, the breakdowns that we've seen over the past couple of decades, which I largely attribute to the growth of passive. A lot of other people would say it's the Federal Reserve or money printer goes burr, et cetera.
Yeah.
I don't see as much of a role for that, but I do think that it impacts it, as I've already talked about, right? So high interest
Yeah.
rates perversely don't cause the stock market to fall. They actually increase income and prevent people from having to sell, which is, really bizarre when you actually think about it in terms of economic theory, right?
Yeah. Yeah. Where tightening becomes stimulative to a certain
Tightening
extent.
becomes stimulative, correct?
Yeah. All right, Mike, what I'm taking from you, and correct me if I shouldn't take this, but is I think your answer is yes. We are sort of on a collision course with this destiny, unless we do something, unless we exhibit a intelligent proactivity that we haven't been exhibiting in the system so far.
Yeah, unfortunately, I think that's right. And so, look, I've tried to raise awareness of this. I've pointed out errors in the academic models. I've highlighted the behavior that suggests that this is the case. And just the sobering message, like I've talked to the CFA Institute, right, which is supposed to be the Institute of Knowledge for Trained Financial Analysts. And the reality is that things just move so slowly that once you start down a path like this, it's very hard to pull back from. It's
Sure.
the lemmings headed towards the cliff, right?
It's like everything. I mean, science, they say it advances one funeral at a time, right? You
Right.
have to wait for the old thinkers to die out, basically. Yeah.
Yeah, and so, anytime I come forward and say, look, passive is a real problem, you can find any number of academics from the 1960s and even more recently who were trained by those individuals who will say, it's not that big of a deal. We should wait and see, the market will come up with a solution, et cetera. And by the way, I'm actually super sympathetic to that. That's one of the things I love about capitalism is true capitalism is simply a system in which I don't have to come up with the answer. I just have to pay the person who does, right?
Hmm.
But we need to recognize that what we're actually seeing in financial markets are markets that behave because they were designed a certain way, right? And the participants and the rules by which they engage influence that. We chose we chose to make the stock market the tool for American retirements. Public equities became the primary tool for American retirements, as compared to pension systems, which are liabilities of corporations that employ you, or as opposed to a national pension system, which is the same thing just happening on a national level beyond the scale of a Social Security, which at least was supposed to be a social insurance function. When you make those choices, you have to understand there will be implications associated with it. One of those is perversely the components that I'm describing, right?
Right, right. And if you design a system where people are supposed to respond to price incentives and then you muddy price discovery, you also have to own that that's going to have repercussions.
Correct.
All right, let me, one last question on this, then we'll start wrapping it up. So another thing that could impact the giant mindless robots flow of passive capital is a big enough recession. And I know nobody's talking about that right now because it's soft landing or no landing as far as the eye can see if you listen to the main narrative. But at some point in time, we're going to have a recession somewhere, right? But a recession could impact this story, right? A big enough
All else
recession.
being equal, yes, a recession would have a recession that feels like a minor recession actually could become a relatively severe recession very quickly. And the same dynamic I was talking about, interest rate hikes becoming stimulative. Ironically, if you start lowering interest rates at exactly the same time that a recession is occurring, so that you have deteriorating corporate profitability, which means that the interest rate is really not the determinant of your credit worthiness or your ability to meet your payments. It means that the corporate activities have suddenly now become a potential albatross. You can create feedback loops that go in the opposite direction, right? So I think the risk is that if we have a recession, I think this is part of the reason you see some of the behaviors that you see. If we have a recession, it could actually end up being much worse than people had anticipated. Um, the other component that I would just emphasize though is that multiplier. As long as those flows remain positive, right? So if enough people lose their jobs, then you'll have outflows from the baby boomers, and you won't have as many inflows from new employees. That can turn the flows negative. That can cause the sort of events that I was talking about. But the flip side of that is if you don't see a significant impairment to retirements, those multipliers get higher and higher and higher, right? So like a very mild recession, like we may have very well had in 22 and 23, could be actually a factor that contributes to this type of behavior, right? People largely kept their jobs. Employment has remained relatively robust. Therefore,
Mhm.
flows have been more robust than we would have anticipated. And with baby boomers not selling because they're now receiving their income in the form of interest payments, there hasn't been a huge incentive to sell, right? That correction will come at some point. It's just a question from how high does it come and how people have built their expectations around it.
Got it. Well, we can talk about this maybe next time you come on the channel, but I just want to tie this back to the earlier discussion about if President Trump really aggressively goes after his stated policies and they do require that short-term pain, that could be a trigger for this type of thing that we're
100%.
talking about. Yeah.
Yeah, I mean this is the fear, right? That there's the Kurt Vonnegut story, how does the world end, or what are the last words spoken by the human species, right? I wonder what this button does.
Yeah.
Um, Anytime you make significant changes to policy and the magnitude that is being discussed in the Trump platform, you can't really know, right? You don't know what the initial conditions were to allow the chaotic system to become predictable, right? Your
Yep.
initial conditions could be radically different than my initial conditions, could be radically different than a 22-year-old's initial conditions. I would certainly hope they would be. Um, and as a result, we can't possibly model every aspect of how this is going to affect us. So when you make those radical changes, you have to be prepared for unforeseen outcomes.
Okay. So, Mike, if I can ask you, put yourself in the position of somebody watching this video right now who's just a regular investor. They've just listened to this. They said that Mike Green is a smart guy. I'm concerned about the risks that he and Adam have talked about, but it looks like for the foreseeable future, even though we're at these nosebleed valuation levels, it could go even higher from here. So, what sort of investing strategy and/or assets do you see as fitting this moment in time and where we are in this journey?
So the thing that I always remind people, and most of your listeners will be very close to this point, right, is recognize that the majority of investors that you're now facing don't actually have the capacity to ask the question, do I need this next dollar, right? Do I need this incremental return? And I see a lot of people that are basically trapped right now in a model of, well, my neighbor made 25%, therefore I want to make 25%.
Mm-hmm.
For most of your listeners who are going to be a little bit older and going to be closer to retirement, really, I would encourage you to start thinking about what are alternate things that I can invest in that will add significant value to me or to my family, right? I think we're seeing a lot of evidence of this. This is families helping their children buy homes, if they have the resources, et cetera, replacing a mortgage that the child would have to take out at 7.25% right now with, okay, you know what, I'll just give you the money from my money market fund, or I will borrow money, or, I will lend you a down payment to allow you to get a better rate, those sorts of components, and charge them interest, right? I want to emphasize that, like, I'm not opposed, particularly to small investors, having access to the low-cost tools associated with index investing. Up to a point, it has very little impact on things like valuations and separating the markets. I just think we've gone past that point. And one of the solution sets associated with that for an investor is to start thinking about, what does that money actually mean? How can it impact my children? How could it actually be used as compared to just kind of panic saving in the S&P? The second thing that I would emphasize for people is, on that same line, like, so much of what's being offered in financial markets and fixed income is being ignored because people are trained to think that assets kind of have embedded returns, right?
Mm-hmm.
That equities are supposed to return 8% a year or 10% a year or 13% a year, depending on the study that you look at. And you can convince yourself of this all you want. Part of my message is a lot of those returns are actually a byproduct of that price appreciation, that valuation increase that I was sharing with you. And those are likely to reverse going forward. And so at some point, you just have to look at the fixed income market and say, can I achieve my results, for my own objectives through fixed income markets and increasing that? I'm not saying go out and abandon the stock market, but simply realistically look at what you think the expected returns are going forward, and understand that a lot of the behavior that we're seeing in terms of prices going up as rapidly as they are is not a signal that, like, the economy is going gangbusters and you're going to be left behind if you're not participating. It's a bit of a collective societal mania that is caused by the form with which we've chosen to invest in these markets.
All right. And for folks that are watching that would like some additional explanation on how to invest in the fixed income world, highly recommend you check out the videos I've done on this channel with Stephen Bavaria and his income factory framework. All right, Mike, now the most important question here. For folks that have really enjoyed this discussion and would like to follow you and your work, between now and the next time you appear on this channel, where should they go?
Well, they have two choices. They could immediately go to a psychiatrist's office because they clearly have problems, or they could go to simplify.us, which is the firm that I'm associated with as chief strategist. We offer a variety of products for the particular focus in the fixed income and income generation space that we hope represent alternatives for investors in their portfolios. And then if you're really interested in just the various drivel that I put out, I'm active on Twitter as ProfPlum99, and I have a Substack, yesIgiveafig.com, that is available for Simplify investors at a discounted rate, and for all investors at a, what I would argue is a very reasonable rate.
All right, fantastic. Hey, Mike, when I edit this, I'll put the links to
Perfect.
Simplify and Yes, I Give a Fig up on the screen. Mike, stay with me for 1 second. I got 30 seconds of housekeeping, and then I want to give you the last word. Folks, if you really enjoyed having Mike on this channel, would like to encourage him to come back on again as soon as his outlook has anything material on it that he wants to communicate to the world, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you want some help in putting some of the insights that Mike has shared today into your portfolio, obviously go check out Mike and his team there at simplify.us. But I recommend most people, if you're looking to implement this and would like some help with that, work with a good financial advisor who understands all the macro issues that Mike and I talked about here. And when you kind of put those requirements together, good, professional, and understands the macro side, that universe actually gets pretty shockingly small. But if you've got a good investor, a good advisor who's doing that for you, great, stick with them. But if you don't, consider scheduling a free consultation with one of the advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes a couple of seconds. These consultations are totally free. There's no commitment to work with these firms. It's just a free public service they offer. By the way, if you go to thoughtfulmoney.com, right at the top of the page there, you can click our newsletter link and sign up for our Substack. And I just want to thank Mike. This week's macro pass for our premium Substack subscribers is going to come from Mike and his Yes, I Give a Fig Substack there. So you can get a little taste of it and then hopefully decide, yeah, this is great. And then you can sign up for Mike's Substack as well. All right, Mike, this has been a great discussion. You're one of my very favorite people to talk with. I've got a whole bunch of notes that we didn't get a chance to get to, so we'll save that for next time. Any parting bits of counsel to today's investor who's, just trying to make sense of this market we have and hopefully not become collateral damage to some of the risks we talked about?
Yeah, there's a mixture of hope and not, right? Part of what I tried to convey is recognizing what money is supposed to be for, which is investing in you and your children's futures. We often lose sight of that with the objective of investing to accumulate a stockpile of assets and strictly think in terms of those returns. As there's two benefits that I think people really should be thinking about at this point. Figure out ways that you can invest in your family and your communities more. As a society, we've lost focus and we've effectively said the only way to invest is in multinational companies in the S&P 500. And I think that's incredibly false. There's opportunities for you to change your children's lives, to change your life and your community's lives for the better by thinking about different ways that you could actually invest both time and money. So while it works against my interest as a public equity and public fixed income investor, I would encourage people to start thinking about what it actually means to invest in your community and your family and try to do more of it rather than less.
All right. Well, that's, I see that just as good sound advice to building really true wealth, right? It's not just the monies that are in the digits that are in your brokerage account. It's in the making the difference in the world that you really want to have. Well, look, Mike, thanks so much. Again, like I said, it's always such a pleasure. Really appreciate it. Everybody else, thanks so much for watching.